Hey, good morning, everybody. I want to welcome you to today's event. This is a five-step process to trade with confidence. It's Saturday, May 16th. You got John Hopkins here. Tom Bowley going to jump in just a minute. We got a great crowd. What a great looking crowd today. We have a lot of people here today. It's a gorgeous day here in Charleston. I'm always interested where people are from. So if you could just put in the chat where you're from. I got a bonjour there, so I'm assuming we got somebody from France, but I don't know. Maybe not. But okay, we got Washington. I'm sure we always have a lot of Canadian friends. Keep it coming. Where are you from? Just put it in the chat. Houston, Texas. There we go. Philadelphia. All right. What there's anybody here from Michigan? I'm from Detroit originally. Nashville, Williamsburg, Virginia. We got a great variety. I'm sure Connecticut. All right, beautiful. Howell, Michigan. There we go. All right. I've got a fellow Michigander. Dallas, Boston. There's our first Canadian. I know there's more. There's another one. Bonjour. my little bit of French coming in handy. United Kingdom. All right. First, I want to welcome anybody who's new to Earnings Beats. We appreciate you taking the time to stop by. I think you're going to find this to be an extremely valuable event. Want to welcome all of our existing subscribers. We have members been with us since we started back in 2004, 22 years ago. Fantastic. Wouldn't be here without our subscribers. Thank you so much. All of our events are recorded. If for some reason you were unable to stick around for the entire event, not a problem. We'll make sure you get a copy of the recording. Now, before I bring Tom in here, just a couple of something really quick I'm going to bring up. I'm not going to spend a lot of time on it now. I'll come back a little bit later when Tom takes a water break. Every time we do one of these events, we want to show our gratitude. So we have what we call a flash sale. You're going to see later, this is the best flash sale we ever had. Hands down. I'll talk about it. You can go to our homepage if you're too interested to wait. Go to our homepage. You'll see the flash sale, and you'll be able to sign up for an annual membership and save a lot of money. That's our way of thanking you for taking the time to come by and spend the morning, Saturday morning, with us. All of you who are with us today. Thanks so much. So today, we got the five-step process to trade with confidence, Tom. This is a unique event. I think this is the first time we've really, you've shared some of the inner workings of your brain and how you look at the market and how you approach the market and why we've been, successful for so many years with our, portfolios, particularly our model portfolio, which we started, 6-7 years ago, which has totally blown away the S&P. And by the way, I'll mention just before I forget it, we got a big event coming on Monday night too, which is our portfolio draft, where Tom is going to lay out 30 stocks for people. You'll hear more about that as well later. But Tom, up until Friday, this happens a lot, by the way, selling the news. Everybody's anxious about the president. You're going to China, what might come out of it. The market has run tremendously, since that bottom on March 30th. Was ready for just, a little bit of pause. So I'm sure everybody's wondering, what might be next. And maybe the information you shared today will give them an opportunity to take advantage of any pullbacks we get.
Yeah, it was kind of interesting this week because we had, I thought, reasons for a sell-off with the PPI and the CPI that came out earlier in the week.
Yeah.
And semiconductors just kind of scoffed at it, which was pretty interesting given that, growth stocks, especially extreme growth stocks, would be the ones that would be hurt the most from an inflationary environment. So seeing how the growth stocks reacted there, I thought was really interesting.
Yeah.
But of course, John, you and I know Max Payne, you never know what's going to happen. And I woke up Friday morning after the market had kind of shaken off both the inflation reports and it also shaken off the fact that the 10-year Treasury yield had moved up to close at its two highest closes since July of last year.
Mm-hmm.
And the market was just sitting at an all-time high, ignoring all of that. And then we wake up on Friday morning with options expiring, and all of a sudden NASDAQ was down almost 2%. uh, overnight.
Yeah. By the
Don't make
way,
this stuff up.
what Tom's referring to, is Max Payne, the third Friday of each month, the monthly options expire. There was a heavy disproportionate number of calls to puts. Everybody's all in. And we have found pretty consistently, and we saw it yesterday, and wouldn't surprise me, by the way, to see a follow through Monday or Tuesday, Tom. And quite often, options settle up, day or two after the month ends. So it's going to be really interesting to see if we, get a little bit more of that selling when the week starts. But anyways, I know you got a lot to cover. By the way, if you like what you're seeing, make sure you like us here on YouTube. Our community is growing there, and your help really makes a big difference. But Tom, I'm going to step aside. You got a lot to cover, and I'll be back a little bit later to just tell everybody about the best sale we've had.
Awesome. I did see a couple of comments about echoes, but it only seems to be a couple of people. If you do have more than one window open, make sure you close one, because that probably will be generating that echo, but there shouldn't be an echo. I mean, I'm not seeing it from everyone, and I'm certainly not getting any kind of an echo. So it may just be on your end, but I'm sure we'll have someone troubleshooting with you in the comments if you continue to have problems.
By the way,
yeah, you mentioned you could see a little bit of an additional sell-off beginning of the week. I just want to mention, historically, the worst day to be in the stock market since 1950 has been the Monday that follows option expiration Friday, and that will be Monday. So not that it goes down every day, but throughout the year, since 1950, there's about a 53% chance that a day is going to be higher. That's been, 53% of the days since beginning of 1950 have been higher. That number drops to about 37% on the Mondays that follow option expiration Friday. So again, it's not a guarantee we go lower, but we like to follow trends. We like to follow history, seasonality, some of the things we'll talk about a little bit later in the program today. But just be aware, that wouldn't be out of the ordinary. That would actually be kind of ordinary for the market to see some additional selling at the beginning of the week. So we'll see about that. Couple of things. Let's go ahead and pull the agenda up, and I'll talk a little bit about where we're going with this session. I could literally talk about this stuff for days, certainly for hours, but I also understand everyone has a life here, including me, and so I'm going to try to condense a lot of things that I would like to talk about into about an hour, no more than an hour and a half. And so that's kind of the time frame. If for any reason you need to leave, you can't stick around for the whole thing, we are recording this. Everyone who is registered for this event will get a copy. So don't worry if you need to leave, or if you're going to leave and then come back later or whatever, you're not going to miss anything. We'll make sure that you do get that recording. But let's go ahead and get into this, because it is going to take some time to get through many of the things that I want to talk about today. As John mentioned, this is kind of a first for us. We've had sessions where we've talked a little bit about what we do, but not a lot of detailed information. And so this is a little bit new in that regard, in that I am going to go through essentially all the steps I go through in putting together our draft for our portfolios, which, as John mentioned, will be coming up on Monday evening after the close. If you're kind of curious why we would be doing a draft now, what we end up doing is we try to get through earnings season. And so it's based on the earnings cycle. So once most all of the companies have reported, that's when we go through and we do kind of go into what I consider my war room, and go through a lot of the things I'm going to talk about today in order to come up with the stocks that we're going to put into each of our three portfolios. We have a model portfolio, an aggressive portfolio, and an income portfolio. And so prepping for that includes all these steps that I'm going to be going over today. So that the culmination will take place on Monday, and the timing, the quarters for us run from February 19th to May 19th. May 19th, which is Tuesday, that's why we're announcing the picks on Monday. May 19th to August 19th, August 19th to November 19th, and then in November 19th back to February 19th. That's our cycle, and that's our quarters. And I just want to kind of clarify that, because most folks, when you think of quarters, you're thinking calendar quarters, first quarter, second quarter. These portfolios run a little bit different. The idea is Let's get through the earnings season. Let's see what the market is telling us about where the strength is, where Wall Street is putting its money, and then let's construct our portfolio. That's kind of a real key that I don't think a lot of folks think about. But once we've gone through an earnings season, until the next earnings season, there are generally going to be some leaders that can help carry your portfolio. So I'm gonna start off a little bit talking about our process background and how this all came to be. Then I'm going to go through the steps. So step one, evaluate the market. Those of you who have been members of Earnings Beats for a while know at the beginning of the year we do a market vision event that kind of lays out the groundwork and what we see for the market, how we expect the market to unfold during the year. If you've been to those events for the last 7 years, you know that our forecasts have been, I mean, some years spot on, other years pretty darn good. And probably the only bad thing I would say about our forecast is that back in 2022, when we called the cyclical bear market at the beginning of the year, and we said it was going to be a nasty one over the first 6 months of the year, and it was. The one mistake was I thought we were going to bounce back in the second half of 2022. That ended up getting pushed back. We bounced back in 2023. Other than that, I mean, our forecasts have been pretty much spot on. And this is kind of the groundwork for what we use to construct these portfolios. We have to kind of get a sense of where we think the market's going. If we think the market's going up versus down, that's going to have a big impact as to how aggressive we want to be. Also, the aggressive areas of the market, are they outperforming? Are they underperforming? All these things go in to evaluation of the market. History, seasonality. I don't pick stocks based on history and seasonality, but I am aware of history and seasonality when I make my picks. So if seasonality happens to line up nicely with a particular area of the market I like, that is only going to add to the reasoning and the confidence that I'm going to have in that trade. Step three, and this one is a biggie, evaluate relative strength. I've done drafts. I've done fantasy drafts with others over at Stock Charts. If you're familiar with I'll lovingly refer to it as our cast of characters over at Stock Charts, Dave Keller and Grayson Rose, Julius DeKempenaar, and some others that I've been friends with for many years. We all kind of have one thing in common. We all like relative strength. We want if you're going to try to beat the S&P 500, doesn't it make sense to try to look for companies that are beating the S&P 500, companies that are leaders within their industry groups, where their industry groups are beating the S&P 500? If you can get into areas where money is rotating, you got a much better chance. And it's not like we're making picks to hold for the next 10 years. We're making picks to hold for the next 90 days. And then it's rinse and repeat. We do this over and over and over again. It's the same process every single quarter. So evaluate relative strength. We're going to spend some time talking about that a little bit. Step four, stock consideration selection. I mean, that seems like that's the biggest part of this. But if you've already done the first three, honestly, I think a lot of times the stocks just kind of fall in your lap. And then it's just trying to decide, you probably have, of the 30 stocks that are going to go in the portfolios, I'm probably down to 50 stocks by then. I mean, it literally, the relative strength process pretty much just drops the stocks into my lap. And then from there, I, look at the charts and look at some other things, maybe a little bit of gut feeling, maybe a little bit based, one company might be really way overbought. Another company that I really like in that same space might be a little closer to support. So I don't feel like I'm stretching and reaching as much, but those are the decisions to make once the stocks, are kind of set before me. The other thing is we do like to try to diversify a little bit. We're still going to be pretty aggressive in terms of growth stocks for the most part. I always tell everyone our model and aggressive portfolios, you should view them as very aggressive portfolios. So if you're somebody in your retirement years and you're really interested in making sure you protect your capital, I wouldn't be putting 100% into these portfolios. I'll be honest. I mean, we have some rough quarters from time to time. We get themes wrong. The market doesn't cooperate. The stocks don't cooperate. Management comes out and all of a sudden, lowers guidance out of nowhere. I mean, that happens. It happens to everybody. It happens to us. So we're not perfect. Our portfolios are not going to be perfect. We don't outperform every quarter. I'm going to show you where the last quarter stands right now. It's been a so-so quarter. Not great for a model portfolio, I'll be honest. But we have quarters like that, and you still stick with the process because over time, we know that process has worked. And then step 5, review AD lines. These are accumulation distribution. So some people might think of AD as advanced decline. I'm not talking about advanced decline, I'm talking about accumulation distribution. This is an indicator that has really grown on me over time. I love stocks that are showing relative strength and show strong AD lines. So that's something that I think you need to at least keep in mind. I certainly do when I'm going through this process. And then the last step there on the agenda, the war room. This is where I just bring it all together. Everything I talk about kind of goes into one spreadsheet, especially when we start talking about different industry groups and sectors and individual stocks within those. And I always liken it to like what I think it would be like in the war room of an NFL team when they're doing a draft, where you've got all these folks on their computers looking at different things and all the things that they've kind of talked about. They're evaluating, their team and their needs, and they're also looking at the talents and skills of all the players that are out there. And then they're trying to figure out what everybody else is going to pick in front of them. And it's just this whole strategy room that they're going through. The beauty with our draft is that we get the top 10 picks in the draft. It's not like somebody else. And I've done these fantasy drafts over with stock charts, folks. And when one of us picks a stock, the other ones can't. And that makes it really hard because we all like relative strength. So we're kind of picking each other's stocks. And the amazing thing is that even after going through that exercise, most of us still outperform the S&P 500 in the fantasy drafts that we've had. And it's because we stick with relative strength. That is so important to putting your portfolio together. Now, if you want to put a portfolio together for the next 15, 20 years, I get it. You're going to put stocks in there that aren't necessarily strong right now. That's not what we're doing. We're not putting them together for 15 or 20 years. We're putting them together for 90 days. So I'm not interested in a company that's looking for a bottom on its chart. I don't want to ride that thing down for the next 90 days while it keeps looking for a bottom. I'm trying to ride the momentum. I'm trying to catch that wave. And you put 10 relative strength winners into a portfolio. What we're looking for is maybe 2 or 3 of those stocks to just keep going and literally pick up the portfolio and carry it higher. That's the whole idea. I know all 10 stocks are not going to work. And some folks might say, well, 10 stocks, that's not diversified. I would argue that if you go much beyond 10, you're over diversified. Warren Buffett said 5. He said if you have more than 5 stocks, I think right now they own 5 stocks at Berkshire. So, I mean, that's the king of investing, most people. And he said that diversification, I'm going to butcher his line, but basically something like diversification is a sign of ignorance. And he didn't mean it in a disparaging, nasty way. He just said, okay, obviously you're not up on the market. You don't understand the market, and therefore you think diversification is the way to go. So ignorance in the sense that maybe the stock market isn't something that you study, that kind of a thing. But he said if you want to do well in the stock market, you concentrate. You concentrate in the best stocks that are out there. If you hold on to an Apple for 40 years, it didn't matter what else you owned. Apple carried your portfolio for the last 40 years. So if you can find those leaders every 90 days and stick with that strategy, some 90 days, things are going to turn on you. Other 90 days are going to be great. Anyhow, let's go ahead and jump into this. So let me start off with just a little bit of background. So first, before we get into all of this, I do want to just say, many of you are new to Earnings Beats. Maybe many of you are new to me, maybe haven't seen me before. I am the chief market strategist at Earnings Beats, been here since 2004. It goes back 22 years. There was about a 4-year stretch from 2015 to 2019 where I actually was still doing some work with Earnings Beats, but I went full time with stock charts as a senior technical analyst. So was over there with Arthur Hill. Some of you might know Arthur Hill or remember Greg Schnell, late Greg Schnell, great friend of mine. Miss him so much every day. And then Julius DeKempenaar, Dave Keller, Grayson Rose, Mary Ellen McGonigal, Aaron Swinlin. Aaron and I co-hosted a show, the first show that Stock Charts did when they were started doing webinars. They had a Market Watcher show, which was every day at noon. And they wanted me to host the show. So I hosted the show with Aaron. And that jump started Stock Charts and doing videos and migrating to YouTube and doing a lot of the stuff that they do today. Anyhow, that's a little bit of my background since 2004, since we started Earnings Beats. Prior to that, I was a CPA, practicing CPA for over 20 years. I was in public accounting in the Washington, D.C. metropolitan area, and I was a partner, was in charge of our firm's accounting and auditing policies, handled audits of wholesalers, printers, law firms, country clubs. That was a fun one. But most importantly, banks. That's where I learned a lot about banks and the role that banks play in the stock market. You always want a healthy banking system. And it doesn't mean banks need to lead the market to the upside, but they need to be somewhat healthy. When banks start struggling, that's a problem because their management is very, very conservative. And if their profits start to weaken, they don't really want to lend money because that's risky. And so they tend to, kind of keep things close to the chest. That makes it very difficult for the economy, the economic environment to continue to grow. So you got to be careful. You got to watch the banks, but not necessarily. I don't look for them to lead, but I do want to watch them to make sure that they stay relatively healthy. Anyway, all of that was in my background, but I still stay true to my core fundamental beliefs as a result of those 20 years in public accounting. And I think the one thing, there are probably several things that really where Earnings Beats is set apart from a lot of other companies, but I think one of them is the fact that we are fundamentalists before being technical analysts. We marry the two together. And so you'll see when we're putting together these portfolios that there's a lot of importance placed on fundamentals as well as technicals. So we want strength in both, not just technicals. We're not just buying a stock because the lines on a chart are telling us this or that. We also want to have some confidence in management that these companies are doing the things that they need to be doing to grow their business, to provide that confidence for Wall Street to invest in them. So really important part of what we do is marrying fundamentals with technicals. So on your screen, I wanted to show you, proof is in the pudding, right? We've been putting these portfolios together for our members since back in 2018, November 2018. And I would say our flagship product at Earnings Beats is our strong earnings chart list. And I'm going to tell you right now, everyone who attends today, we're going to give you a copy of that. Right now, there are like 580 companies, I believe, that are on our strong earnings chart list. Think of a chart list, if you're not familiar with stock charts, think of a chart list as a watch list. It's just it's a organized list of companies that have beaten Wall Street estimates as to both revenue and earnings. They're liquid. So in other words, they trade enough shares. You don't want to get into companies that are illiquid, that, you're basically controlling the market when you buy a stock. You don't want to be in that. So much manipulation. Stocks must trade over $5. These are just filters that we like. Got to trade over $5, needs to be liquid, got to beat Wall Street's estimates, top and bottom line for the latest quarter, just one. Doesn't have to be for the last 4 quarters. Just want to beat the last quarter so that we see that management is currently executing their business plan. And then technically, there has to be something on the chart that I like. Now, if it's a semiconductor and going higher, it's probably on the list if it's, met the other filters. But if it's a restaurant, restaurants have been going down relative to the S&P 500. You better show me something if you're a restaurant. You better show me that you stand way above the crowd. If you want to get on our strong earnings chart list, you got to be a leader in a really poorly performing area like that. Sometimes the company might be downtrending for the last year, 2 years, 5 years, and then they come out with this earnings report that's beaten estimates. They raised guidance, and the stock just soars. That kind of gets, I get a little bit more excited about a company like that. I notice that company like that might find its way onto the strong earnings chart list, but that's our flagship product. From there, companies go into our portfolios. They must have beaten Wall Street estimates as to revenues and earnings in their latest quarter, with only a few exceptions. And when we made these exceptions recently, the Mag 7 stocks, they've had such a long history of great performance, we're giving them a pass. Because many times if they miss in one quarter, chances are they're going to bounce back, or they're going to lower their guidance so that they can beat the next quarter. And these companies have a history of bouncing back and doing really well. Many companies in the market have this history of maybe doing well for a quarter or two, and then they go right back in the dumps. That's why we tend to only stick to companies for 90 days, and then we move on. Because many of the companies, we have a company this quarter, Fastly, great quarter last quarter. Put it into our aggressive portfolio. It was $17. It ran to $34. It doubled. And literally they came out with their latest earnings probably less than 10 days ago, maybe a week ago, 8 days ago, something like that. Well, it had to be more than a week ago. It'd been Saturday. But maybe like Thursday of the prior week. I want to say maybe it was like the 7th or 8th or something. Anyway, they came out and the company absolutely got crushed back to the downside. So it's been a full ride. It was 17 when we put it in our portfolio, got up to 34. They came out with earnings. Company's been falling back. It's now back to 17 again, literally right where we put it out. So, but that is, kind of a poster child of what happens to a lot of smaller companies. They have a great quarter, they go up, and before you know it, within a quarter or two, they're getting hit again back to the downside. Unfortunately, this occurred while we were still owning Fastly, so we've had to suffer the consequences of it coming back down. But that's just the nature of many companies. They go up, they come back down. They go up, they come back down. You have some like Apple that just go up and up and up, and they just keep going up. They just keep getting more and more valuable. I think some of these semiconductor companies that have been making a big run probably are, look at NVIDIA. NVIDIA has been a great company for a really long time. There are certain industry groups where I think you have better odds of finding companies that are going to continue moving higher. And that's why we focus a little bit more on those groups. But anyway, I wanted to show you performance of our portfolios. Down at the bottom, we have an ETF portfolio. Really not talking about that today. We want to just talk about individual stocks. So you can see our portfolio performance. We have 3 portfolios. The only reason we don't show the income portfolio up here is that it's not a portfolio where we're trying to beat the S&P 500. And it's a portfolio where, to be quite honest, you're not going to beat the S&P 500 because we're in a secular bull market where growth stocks are leading. Growth stocks don't pay dividends, many of them. So as a result, income portfolios have lagged for many years throughout the secular bull market. So we kind of felt, we continue to post our results for our members and all, but we kind of felt like to the public, anybody looking at our income portfolio would say, wow, these guys are really bad. When it's not that, it's really the strategy behind the portfolio itself, which is we don't accept any portfolio put together, an income portfolio, unless the average dividend yield is at least 1%. Well, that takes out a lot of companies that you need to have in your portfolios to beat the S&P 500. Anyhow, we show model and aggressive. What I really want to, and you can see this quarter, which again, quarter ends on Tuesday, which is the 19th of May. But here's this quarter. Model portfolio's up. It's up about 1%. We're lagging the S&P 500. It happens. Our aggressive portfolio recently was probably up, I don't know, 6, 7, 8% above the S&P. But literally through these last earnings, I would say going back the last 2 weeks, we've lost a lot of that strength, and we're up 8.6. We're up slightly above the S&P 500 right now, a little less than 1% above, which is, when you think about it, not bad. I think it's really hard to beat the S&P 500 this quarter because semiconductors are, I mean, if you don't have a portfolio of a bunch of semiconductors, you're probably struggling to beat the S&P 500 because that, along with maybe a handful of other groups, is what's really driving the entire S&P 500. So if you're diversifying at all into other areas, chances are you're not going to beat the S&P 500, even with leaders within those groups. So I think this has been a challenging quarter in the sense that, first of all, we started off weak. And then when we did finally start to rally at the end of March, it was a very, very concentrated rally in areas like semiconductors. But anyway, we keep this stuff. We don't hide our results from anyone. And it is all time stamped. We've done every quarter, we have a webinar like we're doing on Monday night to pick our stocks. We do that before the stocks go into effect. So if you go to our website, if you're a member, we have on our portfolio page the history. Here's the model portfolio, and here is every quarter since we started back in 2018. You can go back in here and look at every quarter. I mean, this was the first one. It was a great first quarter. That's what kind of launched us. S&P in the very first quarter only went up 3%, and we put together a portfolio, went up 25%. We had this company right now. Last time I looked at EHTH, it's still out there. I think last time I looked, it was like a $4 stock. But in that particular quarter, we bought it at 34, sold it at 63. 85% winner. And you get an 85% winner and get a couple of other 40% winners, you're going to have a great quarter. I don't care what the rest of your stocks do. So we've had some great quarters. We've also had some stinker quarters. I'm not trying to sugarcoat anything. Let me show you when inflation first started to hit. Remember that pandemic in the first quarter of 2020? A year later, inflation started to hit. Well, right before inflation really began soaring, we put together our portfolio of growth stocks. You want to see what ugly looks like? This is one thing that ugly looks like. S&P 500 went up 5%, but look at all of our growth stocks that we put in, all of them getting clobbered. So like I said, if you're a retirement folk, you're in your retirement years, you don't need quarters like this. So think of these portfolios as being aggressive. That's really important. We're not going to get it right. I think we do a really good job of evaluating the market. Members, if you're listening in and you want to type in anything, feel free. Talk about our market calls over the years and whether or not you trust the way we approach the market. I think that'll help a lot of folks out there maybe that are just learning about earnings beats. Anyhow, let's take a look. I think I went over pretty much everything in background information. So let's look at step one, which is evaluating the market. So the first thing that I do, oops, I got this on that's going to be a poll question we're going to get to later. The first thing I do is I just evaluate the S&P 500. I mean, that's the benchmark. I'm trying to beat the benchmark. So why don't we start by evaluating the benchmark? That's kind of an important thing to do. Now, I would say my default chart when I start evaluating is 1 year, but you need perspective. You need to be able to look beyond just this 1 year chart, because sometimes you get really excited by these moves to the upside. You get really depressed by the move to the downside. So your emotions can play a big role in determining, what you think about the market at the time. Right now, a lot of people are much more bullish than they were 2 months ago. Market's a lot higher now than it was 2 months ago, but that's just the way the market changes our feelings about the market. So I start with a daily chart. I don't see anything horrible about this chart right now. I mean, we got a breakout. To me, technicals, when you look at the price action, that is the most important thing to look at. Everything else I'm going to talk about in terms of evaluating the market is a secondary indicator. This is the primary right here, price action. S&P 500 has been going up, setting new all-time highs. Check. That's good. I'm generally not going to talk too poorly or too bearishly about a market that is absolutely exploding to the upside the way this market has. So that's step one. Step two, I'm going to go out, look at a weekly chart. What's the weekly chart look like? Are we stretched? Have we been going up for an extended period of time? At the end of 2024, I was starting to get a little bit bearish. And one of the things that I talked about was just the fact that as we kept going higher in 2024 on the weekly chart, the PPO kept dropping. So there was a little bit of slowing momentum from a longer term perspective. We'd had a big run and, big run without much of a pullback to the downside off of the 2023 correction. And if you want to go all the way back to the 2022 bear market low, that was a huge run we had had. Now we're starting to show a little bit of wear and tear on the weekly chart, pullback. And then after the cyclical bear market that we had in 2025, you can see the big reversal back up again. And then near the top, what was happening again? Lower PPO. So again, as we went into the beginning of this year, which I was a little cautious about, talked about a correction. I thought we could probably get a correction in the first half of the year. We got it in the first quarter, just like we did in the first quarter of 2025. Similar, but not as steep. And then we rebounded out of it. We're moving back to new highs now. But what this has done on the weekly chart is we've gotten a PPO centerline test. At that point, any issues in the past about divergences is gone because there's no slowing momentum. There's nothing. When you get to a zero line test on the PPO, your short-term and long-term moving average are exactly the same. There isn't any slowing. We're back at square one. We're starting over again when you get to zero. Same as in here. Some people make the mistake of look at this breakout here in June. I'm going to annotate this just for a second. So because this is a mistake that a lot of people will make. And right here, they see this breakout right here. And they say, oh, no. And maybe even, take it back a little bit further like this. And then they'll look at the PPO. And at this time, it's probably about right there. And so, I'll see someone draw a line like this and say, well, the PPO right now is here. We have a negative divergence. PPO is still below where it was, and yet prices moved up. And that is not at all the way I look at negative divergences. Like I said, once you get a center line test, I don't go back before the center line. I don't compare the PPO here to back here because here we're just getting started. This is a new breakout. This is a new trend. I don't go back to the prior highs on the PPO. And that would have been a big mistake because if you see this breakout and you're looking at this, first of all, a couple things. Number one, the PPO is a secondary indicator. Price is a primary indicator. So price trumps the negative divergence to begin with. It is a warning sign, but in this case, it's not even a warning sign for me because this is a new trend that's beginning. We've already had the issues associated with that negative divergence. That's behind us. We're starting over. So now we're moving up. Now, if you're looking at this as a negative divergence, you see the S&P break out at 6,060. Well, it was 6,150 or so was the breakout. You missed the whole run to 7,000. I mean, because there was, until at least, I guess, you got the negative. Maybe here, maybe by the time it got to 6,750, you had gone back up, and then maybe you're still looking at this, or maybe you're looking at, where the PPO was all the way back, 5 years ago. Where are you going to stop? Let's keep going back further and further. Why don't we go back to year 2000 when the S&P and the NASDAQ shot up, at the end of 1999? We've never taken out those PPOs. Or have we had a negative divergence for 26 years? Of course not. These reset. Momentum resets. When you get to zero, it's over. So this is a new trend. I'm looking at the PPO accelerating, and I'm looking at price action breaking out. I love the action. Price-wise, I have no issues whatsoever with this market. Some are saying, well, it's overbought. Well, you know what? On the weekly chart, we're at 69. We're getting close to 70, which is generally considered overbought. But look here. We got to 70 back in January of 2024 when we were at about 4,800. We were even more overbought 2 months later when we'd gone up another 10%. So again, RSIs, overbought conditions, secondary indicator. You don't make decisions. This is what bearish people do. Folks that just always are bearish the market. They're bearish when the market's going down. Then when the market goes up, they're still looking for reasons not to get in. Oh, we got a negative divergence. Oh, we're overbought. Follow the price action. When you break to all-time highs, you are generally going to want to be long, period. Many times we break to all-time highs. You get a secular bull market advance, market doesn't look back. Folks are looking at this market bewildered. But bull markets don't look back. When they break out, they put their head down, and it doesn't matter about the news. Forget about inflation. Forget about the Fed. Forget about higher rates. Forget about this. Just put hit its head down and just keeps going higher. So you have to understand that. 20-year monthly chart. I mean, right now I'm looking at this channel. One of the reasons I was so bearish going into the beginning of 2022, and anybody who was a member back then can tell you, I said first Saturday in 2022, I was looking at a 20 to 25% move lower within 3 to 6 months. I mean, if there's one thing that I am, it's convicted. I will tell you with conviction what I think about the market. And I'm not saying I'm always going to be right, but I've done a lot of research in the market. And when everything starts to line up against the market, to me, it's too risky. And that's the word I always use. It's all about risk. It's not about guaranteeing an outcome. I don't know that the market's going to absolutely go down 20, 25%. But what I do know is that just about every signal that I look at was flashing warning. And this one right here, if you connect the lows from 2009 and 2020 and take that slope of that line and drag it, which you can do on stock charts, I can show you. Let's see, we'll annotate. If I grab this line, I hit command and lower left. See, well, that didn't do it. Hold on. I'll get it. Next one should work. There. See, I can just take this line. I can just drag it and just put it right up here on this line. And that's what I did. So anyway, what I then do is I try to connect as many highs as I can. And you can see by connecting the highs coming across here, look what happened at the end of 2021. We actually went outside the channel. So now we're just getting too far ahead of ourselves. This channel is going up probably about 14, 15% a year. So when you go outside the channel to the upside, you're really starting to get ahead of yourself, in my opinion. Or even touching the channel, you can ride along, but once you get to the top of the channel, to me, some of the upside is contained. Look at where we are right now. This is one thing that I'll be thinking about putting together the portfolios on Monday, is that I don't know that we've had such a big run up, and I believe that the market is where we remain in a secular bull market. But that doesn't mean we go up every day, every week, every month. And so I think with some other factors, one I'm going to show you here in just a minute, I wouldn't be surprised if this move up to 7,500 doesn't turn out to be an intermediate or, at least a short-term top, and maybe even a little bit further. Now that we're beyond earnings season and we're moving into the second half of the quarter, and again, earnings beats members know this, second half of a calendar quarter, with the exception of the fourth quarter, the second half is significantly worse than the first half of quarters 1, 2, and 3, historically going back to 1950. So once you get past earnings, we had this big run up anticipating earnings. We got the news. Now you got to be a little careful to sell on the news. So what's going to happen over these next couple months? I think things are going to be I don't think it's going to be straight up like it's been for the last 6, 7 weeks. I think we got some issues to deal with. And so that'll factor into some of the things I think about for Monday. Sustainability ratios. So we price action is, when I evaluate the market, price action is number one. And I don't just look at the S&P. I like to look at the NASDAQ. I like to look at the Dow, Russell 2000 small cap, S&P 400 mid cap. I mean, I like to look at all the different areas of the market, large cap versus small cap. Of course, we got the big conglomerates in the Dow. I like to get a sense for where I think money is rotating, or maybe even going to rotate based on other factors that I see in the market. I like to look at interest rates. I'm not really getting into that today. Again, I've got to try to condense this so that we can get through all of this within an hour and a half, because it's probably going to be an hour and a half. So there are a lot of different things that I look at. But one of the big ones, and I wanted to talk about this, the S&P 500 versus sustainability ratios. Now, I'm not taking credit for all of this, because I learned intermarket analysis from John Murphy, the late, great John Murphy. Another, it was kind of one of the people I really looked up to. I'm self-taught in technical analysis, but I owe a lot to John's, one of John's books, Technical Analysis of Financial Markets, where he talked about intermarket relationships. And for me, somebody who likes to analyze, being my CPA background, and I like to get in and dig in, check out companies and what makes them tick, and, different things like that. When I look at the market, I look at it kind of the same way. I don't like to just buy or sell based on lines on the chart. I like to do a lot of research in the market. I spend a lot of my free time outside of earnings beats, when I'm not literally working on chart lists or portfolios or any of that stuff, or doing shows. I like to spend time doing research, just trying to find an edge, not just for me, but for our members at Earnings Beats. And I think that these sustainability ratios is one of those edges. And again, it's all born out of what I learned about intermarket analysis from John Murphy. But I like to follow growth versus value. I like to follow, our GDP is 2/3 consumer spending. So it makes a lot of sense. Maybe the most common sense of anything in the stock market for me, when we talk about secondary indicators, is consumer discretionary versus consumer staple stocks. Because right there, if 2/3 of our GDP is consumer spending, doesn't it make sense to check out the health of discretionary, which are more aggressive? If you feel good about the economy, you buy things that consumer discretionary companies sell. Think about a Starbucks coffee. If you're really tight, if your budget's tight, maybe you're worried about your job, whatever, you don't want to spend a bunch of discretionary money on things you don't absolutely have to have. Starbucks latte is something that maybe you enjoy, maybe some other coffee shop, maybe it's, whatever, going out and getting a new car. Even buying a home, that's discretionary, home construction. But you can stay in the home you have. You can fix up the car you have. You can fix your coffee at home. There are things you can do where you don't have to go out and spend that money. And if you start to do those things, that's an indication that the economy maybe is contracting a little bit. And you see it in the way that Wall Street invests in discretionary versus staple stocks. Now, right now, consumer discretionary versus staples, coming off the March low, took off to the upside. We have not gone back down below that, but you can see we are starting to roll over a little bit. It's a concern. It's not something that it's not keeping me up at night right now, but it's something I'm watching. If we were to go back down and put in a new low, that is a major warning sign, because I do consider this relationship to be one of my favorites, and one that I really look at, the closest. I also like the QQQ versus the spider. The NASDAQ 100 is made up of much more growth than the S&P 500. S&P's got a lot of growth companies. I'm not saying there aren't growth companies in the S&P 500, but the QQQ, the NASDAQ 100, has a higher percentage of growth companies. So if you look at the QQQ versus the spider, it'll give you a sense of whether growth or value is winning. If this is going up, growth is winning. If it's going down, value is winning. It's hard for me to get too bearish when I see this QQQ spider ratio going straight up through the roof. And that's what's been happening off of that March low. This rally has been driven by growth stocks, in particular, semiconductors. But that's why we're seeing this massive outperformance here. That's bullish. This is a little bit, it was bullish through mid-April. Now here in the last 3-4 weeks, I'm a little bit more cautious, but we haven't gone back down to a new low. It's not like this ratio goes up every day when the market's healthy. It's going to go up. It's going to pull back. Think about a stock that you like that has rallied and it's pulled back, and then it rallies again, then it pulls back. During the pullbacks, you don't get bearish, the stock. It's natural. You go through periods of profit taking. I believe moving up on this ratio, you're going to have pullbacks from time to time. So just like over here, when we were going up, the S&P was going up, we had pullbacks from time to time. Sometimes with the market coming down, sometimes with the market still trying to go up. But overall, the uptrend was in play. We never went back and started rolling over and putting in lower lows. So here, I don't think, in fact, the breakout that we saw right here was pretty violent over this top. We could just be coming down testing that, and we might see another big run back to the upside. In fact, if I'm right, let's say semiconductors weaken over the next few weeks and the S&P 500 pulls back to the 20-day or maybe even a little bit below. If this ratio is turning back to the upside, that's a really good indication to me that money is rotating into other areas of growth, not semiconductors, but other areas. I'll also be watching key area like software, which is the second largest industry group in the S&P 500. If that was one thing that actually did pretty well on yesterday. Semiconductors got hit hard. Software was coming up. That helped to soften the blow a little bit. So anyway, but I've got other ratios on here. I don't want to spend a lot of time because literally I could turn this into an all-day seminar. But large cap growth versus value. Both of these are large cap growth versus value. This is mid cap growth versus value. Mid caps are struggling a little bit. And part of it is because mid cap growth not really doing as well as some of these other growth areas. Small cap growth versus small cap value. Small cap growth exploding. Transports versus utilities. I think generally we're still in an uptrend here, which is nice. And then copper versus gold is something I like to watch too. Gold tends to go up when everyone's fearful and worried about things. Copper tends to go up. It's an industrial metal. So when it goes up for demand reasons. So when the economy is strengthening. So when copper is going up versus gold, that's generally a good sign for the market. And we've been seeing that of late as well. So anyway, this is part of my evaluation. Correlation, I just want to show you real quick. This is a 26-year chart, all the way back to the start of the century, the turn of the century, the S&P 500 going up, and the correlation between the S&P and the XLY-XLP ratio. And look at the blue shaded area, showing that these two are very, very strongly positively correlated over time. We are up in this top portion of correlation most of the time. Rarely, only one time, have we significantly moved into the inverse correlation where the two are going opposite. Now, when they are going opposite, that is a time when I need to evaluate the market. If the S&P is going up and this ratio is going up with it, there is very little chance you're going to see me bearish the market. So I'll just leave it at that. One other thing in evaluating the market, this is more of a short-term evaluation, but this is something I really like. 5-day moving average of the equity-only put-call ratio. This gives us a sense of what the masses are doing. The folks that like to chase and are always in at the end of rallies or at the end of sell-offs. That, the market's going up. A lot of novice option traders are buying calls on semiconductors. They're so expensive. The group is so stretched. And when when we start hitting extremes in terms of calls versus puts, the ratio of the equity only put call ratio, put to call, puts the numerator, calls the denominator. When the calls are getting really high versus the puts, that fraction drops. Puts to calls goes down on a relative basis or on a percentage basis. And this is what that tracks. So when you see this 5-day moving average go down to these lows that we have seen over this just the past 3 years. So I've got 6 or 7 times marked where we've gone down to these levels. S&P went up a little bit, ended up turning lower. Here we topped. Here, short-term top. Here, a little bit of a brief short-term top. Here, short-term top. Here, a little bit more of a lengthier top. Here, didn't work. Here, just printed. Literally just printed as we hit 7,500. Now, is it going to work? Are we going to pull back? This indicator would tell me, yeah, we've got a pretty good chance that we're going to pull back in the near term, because those chasers, those real, the retail options folks that usually end up losing money because they're trading on emotion, they're chasing rallies, or they're chasing sell-offs, and they tend to go all in or really start to get aggressive right as the market's reversing. And this is the chart that kind of shows you that. So that is basically what I had for evaluating the market. And that's the lengthiest part of this presentation. The rest will be pretty easy. I want to start off now with, I want to go into history and seasonality. And with that, I'm going to start with this poll. And, you know, I've written it out here, but Matt, you can go ahead and bring this up as well. I'd like for everybody to, you know, just give me their thoughts on this. You can see the poll on your screen. Since 1950, 1/3 of the month, consecutive period of the month, has accounted for more than 80% of the S&P 500 gains. Think about that for a second. About 33% of the month accounts for over 80% of the gains since 1950. I'd like to, you know, I want everybody to participate in this. Just take a guess. If you don't, members are going to get it right because they know the answer, but just take a guess, and I'm going to come back to that in just a couple minutes. But before I get into that, I want to show you some seasonality. Some things, you know, first thing I always think about when I think seasonality, and it drives me absolutely crazy. The media, it's a beautiful rhyme. Go away in May. You know, go away in May, folks. You don't want to be in the market in May. My gosh, no, market's going to crash. You know, everybody knows end of April is when everybody just says, hey, we're going to put the for sale sign out. We're getting out of the market. And therefore, if you're staying in May, you're going to get clobbered. All right. I would tend to disagree with that. Going back over the last 20 years, do you know which months have gone up most often? Roughly 80% of the time, April, May, July. So are you going to leave the market in May right before 2 of the 3 best months in terms of the likelihood that a month is going to go higher? That's 2 decades worth of data. Now, if I shorten this down to 14 years, and the reason I'm shortening it down to 14 years is I want to start in 2013. That's when the S&P 500 finally cleared the 2000 and the 2007 market top. Remember that? We were right around 1,550. It was April 10th, 2013. I don't forget numbers. April 10th, 2013 is when we broke out, took out that double top, and we never looked back. That was the confirmation. The bull market started at the bottom in 2009, but you don't know that at the time. You don't know it until you get a breakout. The confirmation came on April 10th, 2013. So since 2013, the S&P 500, I want you to look, April's been good. May is averaged going up 1.6% per month. June, 1.29%. July, over 3%. And then August, another 0.25%. But you can see the strength that comes in during this, you know, starting in May. Do you really want to go away? Why don't the media outlets say, well, go away in May, you know, it maybe is something that used to work, but hasn't worked well over the last, you know, during this secular bull market advance? I would be okay if they would give you the whole story, but instead they come across like they are giving you some kind of great information, and I'm going to poke holes in it because I think it's a bunch of BS. Let me show you something else. This, you know, is absolutely stunning to me. I'm going to go IWF versus the IWD. Growth versus value. When does growth outperform value? This is IWF is the iShares that track large cap growth. IWD is the iShares that track large cap value. So IWF versus IWD. Now I'm going to go back and let's go back to these 14 years during the secular bull market. And I want you to take a look. I'm going to make this a little bit bigger so you can really zero in on May, June, July, and August. The average outperformance of growth versus value. These 4 months, if you add them up, let's see, that's 330, 446, 568. Those 4 months, if you add those 4 months up, the average over the last 14 years that large cap growth has outperformed large cap value 5.68 percentage points per year. Almost 6 percentage points higher to be in growth, large cap growth, than to be in large cap value over the last 14 years. So anybody listening to this go away in May, not realizing that May through August has been a pretty good period, not just a good period, but a period when growth stocks thrive versus value. Look at the other months, by the way. Look at the first 4 months of the year. Let me zero in on those. Little outperformance, underperformance, and then a little bit of outperformance. You add those 4 months up. That is about, I don't know, probably about a half of a percentage point gain, growth versus value over those 4 months. Then almost 6 percentage points over those 4 months. And then let's look at the end of the year where it's negative. Let's see, 15, 22, minus 47, minus 0.47. So we average losing 0.5% in growth stocks in the last 4 months. We average gaining 0.5% the first 4 months. So those 8 months wipe each other. It's completely flat. If you want to prosper from growth stocks for the last 14 years, this has been the best time to do it, May through August. Guess when this portfolio period runs? May 19th, August 19th. Need I say more? So anyway, I had one other seasonality chart I want to show you. This is semiconductors. So we're having a great month of May. Look at semiconductors relative to the S&P 500 for the month of May. April generally is not very strong. And, we went up during the month of April, but look at May. May, the average outperformance, semiconductors versus the S&P 500, average outperformance is 6.3% over the last 14 years. Now, I know this month's been pretty high, so we'll get rid of that. Let's look at the last 13 years before this year. Doesn't even include this year. Last 13 years, May has outperformed, the semiconductors have outperformed the S&P 500 by 6 percentage points during the month of May. So, and you can see 1 percentage point in June, 0.5 percentage point in July, and slight outperformance, very slight, in August. So is now the time I want to back off of semiconductors? You can bet there are going to be semiconductors in my the portfolios that we put together for Monday evening. The question is just finding which ones. And like I said, sometimes you get to the end, got a lot of stocks to choose from, and then you've got to kind of look at the individual charts and kind of make a decision. Some might be so overbought that I just can't put in there. Although, there's something to be said for buying overbought stocks. Wall Street just keeps pouring into them. Sometimes the smaller stocks, when they get going, a lot of times it's retail traders that drive them up. But some of the bigger companies, it's a lot of the big Wall Street firms that are buying those They're buying those stocks. Look at SanDisk. SanDisk, if we pull that stock up, at which point was it so overbought that you feel like there's no way you could buy it? And yet, look at what it just keeps doing. Here it had RSI got up to 85. Who buys a stock with an RSI reading at 85? Not too many people. I generally try not to. And yet this stock pulled back a little bit, and that looks like a little bit. It was probably 15 or 20%. But look at what happened afterwards. It just doesn't stop. Here, we actually had about a 45-day pause, which has been kind of crazy. And then another massive move up. And then another, period, another little pause for 2 months. And then another move up. Notice, though, when did this pause happen? This pause happened in the second half of a quarter. When did this pause happen? Mostly in the second half of a quarter. And notice the big run up. When was this run up? First half of a quarter. When was this run up? First half of a quarter. This is something that we teach, some of the things we talk about with our members all the time. It's after May 15th. We're entering the second half of quarter two. Lower your bar of expectations. Doesn't mean growth stocks aren't going to go up. I'm just talking about the overall market. Bring it down a little bit. You gotta, it feels great. Feels like the market's going to go up every day. It's not. It's going to go through a period of consolidation that may have started with what I think probably option related selling on Friday, Max Payne related selling. We'll see whether or not that maybe accelerates a little bit this week. And then that's pretty much it. So I'm going to go back to that poll. So let's see where we are. Matt, you got that? Is that the final?
Yeah, I think that's the final right there. That's
all
as
right,
big as
so
it gets, though.
57% said the 26th through the 6th. I bet that's a lot of earnings beats members because you got it right. I put the 10th, first to the 10th in there because I think, if I was trying to objectively guess, I probably would have guessed the beginning of the month. Money flows and some other things. So I threw that one out there as a curveball. I think I got some folks to bite on the curveball. It was outside the zone though, so it was swing and a miss. 2 is the correct answer. So think about that for a second. The 26th to the 6th has accounted for over 80% of the gains since 1950. If you're a trader, doesn't that kind of change your thinking a little bit? I mean, if I'm going to ever go out on margin to trade, it's probably going to be during that time frame. And I can tell you the real concentration of strength is right at the end of the month and the first 2 days of the next month. 3 of the 4 best days on the S&P 500, individual days, first, second, third, all the way to the 31st of all months, of all years since 1950, 3 of the 4 best days. First is the best day. Second is the second best day. The 16th is the third best day. And the 31st is the fourth best day. So of the 4 best days, 3 of them are consecutive. 31st, first, and second. Why? Money flows. I got this from when I was in public accounting. This is what one of the things got things rolling in my head was I would do payroll audits and I would see money coming out of payrolls and being sent to the Fidelities and Vanguards of the world with specific instructions to invest their money. Fidelity and Vanguard doesn't get the money and say, you know what, things are a little overbought. Let's wait a week. They can't by law. They have to put that money to work. Money goes into the stock market. And a lot of times it will go not only the first of the month, but also around the 15th of the month. A lot of folks have payrolls middle of the month and the end of the month. Could be twice a month. Some people do every 2 weeks, but I know when we were in public accounting, we had 1st and 15th or 1st and 16th, something like that. And many of the companies I audited were very similar. And so when I saw the 16th was the third best day of the month, and the first and the second were the 2 best, and then the 31st, 31st money flows probably haven't hit just yet. But do you think that I'm the only person in the universe that knows when the money comes in? I bet most of the people on Wall Street know. And if they know the money's coming in on the 1st or the 2nd, what do you think they're doing on the 31st? It's what I call legalized front running, legalized thievery. They're getting in because they know all this money's coming in. So they're getting in ahead of everybody else. And that's why the 26th to the 31st, they're starting to build positions. Then the money flows come in. And then guess what happens after the money flows come in? Then the traders, they're the ones that like to chase. Now they've already seen the rallies. Now they're jumping in. They're buying their calls and puts, and mostly calls. And then you see the market, go the other direction. But anyhow, I always find this stuff to be incredibly fascinating. And so let me move into the next step, which is evaluate relative strength. This is probably the most important, but it's also going to be very brief. It's very, very easy. I don't have to interpret anything. Let me just show you exactly how it works. Here is my industry group relative strength chart list. Now I've got going out 1 month. I'm going to move it back to 3 months. These are all of the industry groups relative to the S&P 500. So over the last 3 months, it tells me in order the industry groups that are leading. Wow, that wasn't very hard. Semiconductors, telecom equipment, heavy construction, computer hardware. You think maybe Apple. Look at computer hardware. This is a 3-year relative chart. So this is showing me that computer hardware is exploding right now relative to the S&P 500. It's at a 3-year high. Look at the absolute chart of computer hardware down here on the bottom. Massive move to the upside. How many people were talking about computer hardware being the 4th best industry group over the last 3 months? Probably not too many. Sometimes what I'll do is also move to like 1 month, and I'll just make sure computer hardware is still on the 1 month. Oh, there it is. 1 month, still showing a lot of relative strength. And then on the flip side, these are areas you might want to think about avoiding. Recreational products, the worst 1 month performance. Now, if I were to pick a recreational products company, and I'm going to give you one that I like, Yeti. So here's Yeti. They just came out with earnings. They not only had a great earnings report, I think their quarterly earnings came in at 26 cents. Market was expecting 17 cents. But they not only beat top line and bottom line, but they also raised their guidance substantially. And so I saw the gap up on this one, and then I saw it sell off the whole day back to the 20-day. And then yesterday actually started to reverse back up again. A breakout above 44 or above that high, which is at 44.11. This is a stock I would definitely keep on my list. I think the thing holding this back is not the company, not its performance, not its relative strength. The group that it's in literally is holding on to its ankles, just pulling the stock back. Yeti wants to go. And if money ever starts rotating into recreational products, then I think Yeti will be a massive winner. But look at the relative strength on Yeti right now. It is a leader in the group. But do I put it in a portfolio? I love the stock. I love the earnings. This is going to be a tough one. I mean, I'm probably not going to. I haven't decided for sure because I really do like the company and I like what it did. It is still in an uptrend, even though it's in a group that is doing this. This is a chart of recreational products relative to the S&P 500. It doesn't get much worse. Money is pouring out of this group. But you still have a company like Yeti that is making it work. And so, one of two things is going to happen. Recreational products going to start getting more money and Yeti is going to take off probably to the upside, or the group is going to remain so weak and Yeti eventually is just going to roll over. It's going to be exhausted trying to move up. There's not going to be enough strength in it and folks are going to give up and start selling. And then the stock breaks back down again. So you can have a great winner, a great leader like Yeti. Now, Yeti, if you start looking at relative strength in terms of something like the scooter score at Stock Charts Technical Rank, SCTR is the acronym. Stock Charts Technical Rank, scooter. It is a relative strength formula developed by John Murphy. And again, if John does it, I'm following it. I'm paying attention. The biggest downside with the scooter, every indicator has its own, issues. The scooter, the biggest problem with the scooter is if you look at the formula, it doesn't go back more than 5 months. There's nothing in the formula that goes back more than 5 months. So you might have a company that's been underperforming for 10 years and it's all of a sudden gotten hot. Sometimes even just initial gap up, a big gap up, stock's at 20 and it gaps up to 30. And all of a sudden that scooter score will go from 28 to 88, in just one fell swoop like that. So that can be a little misleading because it's not really a relative strength leader. It's a gap up from a couple of days ago, or maybe even a couple months ago. So there is that limitation that you have with the scooter scores, but it's still something I think is good to use. You just don't buy a stock simply based on the scooter. Look at the charts. It's something that you can use, just like seasonality, might tell you that 75% of the time this happens. Well, that also means that 25% of the time it doesn't. So how about looking at the chart to see if it looks like it might happen again? If seasonality is telling us that software loves a particular month, how about we look at the chart of software and see if we've got a strong or something that at least suggests that it's going to go higher technically. If we've got that, then seasonality makes more sense. Anyhow, so that is kind of in a nutshell one of the things that I would be looking at in terms of relative strength. So you got to find the groups that are working right now, the ones that aren't, and then look for leaders within those, the ones that are working, or some that maybe might just be starting to improve. So, sometimes I might even go to a 1 week and take a look if something really looks good. Like one group that's starting to get my attention a little bit is renewable energy. So renewable energy, you can see just came back up above its 20-day moving average. Just looks like on a relative basis about to cross its trigger line on this weekly PPO. And renewable energy, I send out a seasonality report to members at the beginning of every month. And renewable energy is one of those areas that loves the month of May. So we could go in here and let me pull up the seasonality. And if we go back, here is through the last 14 years, but look at the average gains in the month of May. 8.66 average gain. Look at all the other months coming across. 6.5 in July, 4 and 4 October, but 8 in May. So this is when this group goes, a lot of times it goes during the month of May. And so then you go back to this chart, and what is it doing? It got hot at the end of April, and it's continuing here in May. So yeah, I see this and I start looking. I'm starting to feel a little bit better about this group. And then there's one stock out there that in this space that if I want to go that direction, Next Power just came out with great numbers. I believe they also raised guidance. And then after gapping up, and by the way, we had let me show you this, because this was a chart that I actually showed in our EB Digest, which is a free newsletter that we offer. So I just like to try to educate using that to kind of show people what we look for and look at. But do you see this ascending triangle off of this uptrend? That's a continuation pattern. So you're looking for a breakout. We posted this right before earnings. And I said earnings could be the catalyst for this breakout coming up. And this measurement is from 130 down to 100, which would be 160. Guess where it went right after earnings? I think the high there was 157. Almost hit its measurement the day of earnings. And then I said, if it pulls back, I think I had talked about this on maybe one of my shows, but I said, if you weren't in and you didn't want to chase it, I said, if it pulls back to 130, that would be a good entry point along with the rising 20-day moving average. Look at this thing the very next day. Went all the way back down to the rising 20-day moving average. And the very next day, if you got it on the 20-day at 125, the next day you were up about 17%, 145. So part of it is it's combining all of these things, the relative strength, the upcoming earnings, the patterns, the technical patterns, the breakouts, and then understanding where the key entry points are on pullbacks. So is NXT going to make one of our portfolios? Look at the relative strength on NXT, by the way. Look at that relative strength from during the first quarter. Now it's kind of gone sideways. Now it's starting to regain strength again with volume coming in with a breakout. The question is this going to be in our portfolio on Monday? Could this be in one of them? Maybe. I don't know. But I'm going to talk about some more stocks in just a minute. But that, in a sense, gives you a little sense about what we try to do with relative strength. We want to find some of the best stocks in the areas where Wall Street's pouring their money into right now. Because you know what? After these companies go up, then Wall Street's going to come out. They're going to start sending out their influencers on CNBC. Oh, I meant analysts. Did I say influencers? They're They're going to send those guys and gals onto CNBC, and they're going to talk about all these things that just worked. And then they're going to tell you about how great these companies are. And then they're going to go back to their offices, and guess what? Money's going to start to rotate. There's a reason why I don't trust Wall Street. There's a reason why I don't listen to CNBC. I have learned over the years through lost money that they don't care. They care about ratings. They care about, CNBC cares about its ratings, because the higher the ratings, the higher the viewership. Guess what? The higher the ad revenue. So that's what they care about. Wall Street, that's the biggest conflict of interest in the history of civilization. You got Goldman Sachs managing money for themselves and their wealthiest clients. Then Goldman Sachs analysts, or influencers, I like to call them, go on to CNBC and tell us what to buy. And then Goldman Sachs has a market making unit that takes the side opposite of what we trade. Now, if that's not the biggest conflict of interest ever, I don't know what is, but that's our system. So you either understand it and use it to your advantage, or you let them dictate everything to you and you make emotional trades. Anyway, I will pass on CNBC. I'll pass on all the media outlets, and I will do my own independent research. And that's what we pass along to members. I follow the money, everything that we talk about in terms of direction of the market calls, tops, bottoms. It all comes from the charts. It doesn't come from the media. It doesn't come from Iran. It doesn't come from the White House. It doesn't come from the Fed, although I do like to follow what the Fed's doing. Earnings and interest rates ultimately drive the stock market, and the money flow gives you a really good sense of what we're going to see in the period ahead. Market looks ahead. We're always trying to react to the news that's going on now. The stock market's looking at what's going on 6 months from now. That's why you never can figure out, why is the market up? We just had inflation reports. We had this, we had that. The reason the market isn't going down because of those things is because they don't see inflation. They don't see higher rates. They see higher earnings down the road. They see lower rates down the road. They see a war that comes to an end down the road. They see interest rates that come down because there are no inflation issues. That's what the charts and the money are telling us. Anyway, I'm going to take just a quick break here. We're going to go over how we go through this selection process of the companies in just a couple minutes. Maybe we're going to go a little bit later than 11:30. The end of this should be pretty quick, but I'm going to turn this over to John just for about 2 minutes, and then we'll wrap up everything.
Okay, I do want to remind people as well, if you can't stick around, no problem. We'll make sure you get the recording so you'll be able to listen to the entire event. Okay, so when we have an event like this, especially when we have a lot of new faces, we like to thank people by offering a deal. We call it our flash sale. And if we can pull up a flash sale on the screen here. Plus, by the way, if you go to our website at earningsbeats.com, you will see the flash sale. And normally our annual membership, Matt, can I get the flash sale up here? Yeah. Okay. It's coming up.
Yeah, Tom, will you, it's on your screen. Will you bring up the flash sale?
Yeah. All right. Anyways, so probably 90% of our members are annual members. And the reason they're annual members because you save a lot of money with an annual membership. Our monthly membership is $147. If you went 12 months, you'd spend almost $1,800 for a full year. Our annual membership is normally $997. The sale we're offering today is saving $300, $697. It's the lowest we've ever gone. We want more people to join our community. Now, what do you get for this? You get Tom's daily market report. If you like what you heard here, he's going to summarize the market every day. But even before he does that, every Monday he has a weekly market report. The weekly market report is very in-depth. And that's where Tom goes over what he sees happening in the very short term, followed by the daily market reports to keep you up to date. Next thing is we have our quarterly market updates. Once a quarter, Tom will go over what he's is seeing the possibility of the market doing over the next quarter. Now, those quarterly updates come out of what we call our market vision events. Once a year, at the very beginning of the year, we do our market vision event. And Tom lays out his forecast and thoughts for the entire year. And that's followed up by the quarterly updates. People absolutely love those. You also get access to our webinars. For example, Monday, this is when Tom is going to lay out for the membership his top picks for the model, aggressive, and income portfolios, 30 stocks in all that are meant to be held over the quarter. So if you want to save a lot of money, and what we find that 1 year is a great period of time to assess us, you're getting a $300 discount. $697 gets you a full year. And I don't know if you do the math, on a 12-month basis, is that maybe 50, 60 bucks a month compared to 147, which is our normal monthly rate. Go to the website. Check out the sale. Ends tomorrow midnight, by the way. You want to get in on everything that Tom is doing and save $300 in the process. Just sign up today. You're not going to regret it. We get so many great comments from our members and testimonies. And if you love events like this, remember, this is a live stream free event. We got plenty of other events that are just for members only. Sign up. I think you're going to find it to be a great value. Anyways, Tom, I know you got stuff to cover, so I'm going to step to the sideline, my friend.
And I'm going to try to go through this pretty quickly, but it is, like John said, our best offer. We get comments sometimes, that people say we're expensive. I mean, I know what other firms charge for everything that we offer down here at the bottom. I think, members, feel free to chime in. I mean, if you don't feel like you're getting your money's worth, let us know. But I think the overwhelming majority of our members are very, very satisfied with what we do and all the work that we put in. There's a lot of research. I hadn't even gone into all the chart lists that we offer. And especially if you're a Stock Charts member, you can download all of our work literally right into your account at Stock Charts. And I'm going to show you some things that we do here in just a minute. But what I want to do first is I want to go back over here and let's take a look. I'm going to pull up our strong earnings chart list. Now, this is a chart list that we are going to make available to everybody here today. We're also going to make available, there's another chart list that I want to send out. That's a chart list of today, of the charts that we've talked about today. Not all of them, but what we will give you, let me come back to this. I want to show you what I have on here. So if I list out here in summary form, so we went over at the very beginning all of these S&P 500 charts showing the 1 year, 5 year, 20-year sustainability ratios, correlation, and the 5-day SMA of the equity only put call ratio, and then poll and the poll answer. Those charts are all on here. But the other thing that I just did a little while ago is I scanned my strong earnings chart list that I'm going to go over with you in just a minute. And I pulled up every stock on there that had a scooter score, Stock Charts technical rank, relative strength score above 95. So 95 to 100. We're talking about the top 5% of all companies out there. If they're on our strong earnings chart list, then they also got added to this chart list. So you will have a list of all of these companies. There, I think we're 70 some, along with the charts that I showed you earlier. So that's going to be a separate giveaway just for showing up here today. I really appreciate it. Earnings Beats appreciates it. We do these live stream events, trying to get the word out, trying to educate. And we know it's a Saturday morning. Hey, the PGA tournament is on. And you all know, or most of you know, I'm a big golf fan. So I'm giving up watching some of the PGA right now to do these events because I'm really passionate about educating folks. You're going to get this chart list along with the strong earnings chart list. So let's go over. I want to show you what we do on the strong earnings chart list. So first thing is that if you pull up the strong earnings chart list and you go to edit at Stock Charts, it'll tell you how many are on here. Right now we have 573 companies that have been already filtered for you. I've already looked at, I mean, I could show you, I go through Zacks.com. There are some days in the middle of earnings season where there are probably 200 to 300 companies that beat earnings estimates. And that's where I start every day. So in the middle of earnings season, like if I miss something or if something doesn't get done by the weekend and I say, hey, this is a really difficult time of the quarter because so many earnings are coming out, you need to know that there could be up to 250 or 300 companies that beat earnings in one day. And I'm going to look at all of those charts to figure out which ones that I believe are ones that I would consider putting on the strong earnings chart list. Then I have to go and look to revenues to make sure they beat revenues, all 250, 300 companies. This is a process that we go through. And then once I do all of that, let's say out of those 250 companies, let's say 50 of them make the list. Those 50 companies I annotate on the chart list and show you where I believe a couple of key support levels could lie. So you've got all of these annotated, vetted charts already filtered for you, literally ready to look at any moment's notice to look to see if there's possible trades out there. Now, you might feel like support is a different level than me, and that's fine. I'm not trying to convince you that my support level is the only support level that matters, but I'm giving you my thoughts. So you're constantly getting my thoughts on a chart, and then you can kind of look at it yourself and say, yeah, I agree with Tom. I think that's a pretty good support level, and we're testing it today. I'm going to take a shot with this trade. That's how you manage risk, is by getting these stocks at key support levels. Because if you believe that is a key support level, guess what happens if you lose it? You take your small loss and you get out. You've got to be disciplined. If you're correct and you hit support right at the right level, just kind of like I showed you on the NXT chart over here. If you bought at 130, that's price support, and or at the rising 20-day moving average, in one day you just made 15% or more. We haven't even broken out. That's just a little rebound. Those are the types of things that you can pick up off of the strong earnings chart list. So I have these in chronological order. So they're numbered. The number itself doesn't mean anything. It's just the order that means something, because Walmart is on this list. Walmart's coming up for earnings in a couple weeks. Now, the only way, I said this a little bit earlier, that in order to get on our portfolios, you have to come from our strong earnings chart list. And I said that there was one exception, Mag 7 stocks. There might be a couple of other stocks outside of the Mag 7 that have great long-term track records that I would include in here anyway. Something maybe like a Netflix or a Costco. But I mean, these are companies that have great long-term track records. And so there are a few of them, and it's just up to my discretion. I mean, don't write in and say, well, why don't you include American Express? Yeah, that's a great company too. There's a bunch of great companies I don't include. I just have about 10 of them, 10, 12 that I do this for. I think AMD might be one. But anyway, that's one way that a stock could get into our portfolios. And you might look and say, well, they didn't beat earnings. Why are they on there? I'm telling you right now, that's an exception. The other way, and there's one that I'm thinking about, a stock that I'm thinking about adding that is not on the strong earnings chart list right now, and I'm going to show it to you. It is CrowdStrike. This is one of the strongest software. Look at all of these hollow candles. I believe Wall Street is pouring into CrowdStrike. If you look at their relative strength versus software, they were going up for the last several months, even while software was going down. This was a group that was outperformed, or this was a stock that was outperforming, but it took it to another level here over the past few, month or not even month, but last week and a half. And I think CrowdStrike, I'm going to see, but I think CrowdStrike reports coming up in just a couple of weeks. Yeah, June 3rd. So the reason that CrowdStrike is not on the strong earnings chart list, I went back and looked. They beat earnings, they beat top line, they beat bottom line. So Walmart also reports June 3rd. You might ask, why wasn't CrowdStrike on this list then, right? That's a Legitimate question. They beat top line. They beat bottom line. They don't report for 2 more weeks. They should be on here. Well, let's look at the chart on CrowdStrike, and let's look at that chart from back when it would have reported before, which would have been early March. Now, right in here is when they reported, probably. I don't know exactly, but I'm guessing would have been early March. Look at the chart. Remember, it's not just about beating. It's also about looking at the chart and seeing if the stock is the type of stock that I would want to include. Is it doing anything technical, that warrants inclusion? Because it's not just fundamentals, it's fundamentals and technicals. And so then, at the beginning, this was the relative strength line. It was just, kind of mostly flat, maybe a little bit up. But at the beginning of March, it wasn't really doing much. And it's in a group that's been horrible. So no, this is not the kind of stock I would be interested in. Now, every once in a while, I will put stocks in that don't look great, that beat earnings. And the reason, if you ever want to know why, think CrowdStrike, because sometimes these stocks beat and then show relative strength later. Now, if I did this for every company that beat, we'd have 1,500 companies on this chart list. So I've got to use some discretion. And so some companies like CrowdStrike are going to be left off, but they did physically beat estimates last quarter. And then their relative strength came later in the quarter. Because I was looking at CrowdStrike and I'm like, man, this is one stock I like. And this is one in software that I could consider. And then I went back and looked and it wasn't on the strong earnings chart list. I was like, oh man, they must not have beat. And then I went back and researched and they did beat. And then I looked at the chart and I was like, oh, okay, that's why I didn't include it. So you've got a list of great companies on here. And like I said, they're all annotated. So let's look at Walmart. So here's Walmart. So this is when the company broke out. I put in a support level right here on this breakout. We went down 1 day below it. I would have gotten probably stopped out had I traded it. But then we were right back up above it, moved through the 20-day. And now as we go into earnings, we got an AD line that's strong. We got, looks like a little bit of a cup. I don't know, maybe if Walmart pulls back into a handle, if they beat top and bottom line and pull back somewhere between maybe 130 and 126, somewhere in this area, I think Walmart could be pretty interesting. Look at the relative strength. So it's showing relative strength in its peers, among its peers overall not so good, but Walmart's a leader. Walmart's a leader with a great AD line, nice little technical pattern, a nice cup. Earnings might come out, or maybe even prior to earnings, we might go down to 126 over the next 2 weeks and put in a handle. And an aggressive trader could take a shot at it right there and hold it all the way back up into earnings, expecting that we're going to get a run up either into earnings or with earnings. Aggressive trade, because again, if you're going to hold into earnings, that's the most aggressive time to hold any stock. But anyway, that's kind of what we do. So if you look at all of our, I don't want to go that way. Let's go to the more recent. So here, this is one of the stocks. When I saw CrowdStrike, then I included FIG, which is Figma, because this company reported great numbers and they raised their guidance. And I looked at it and I'm like, well, it's in a downtrend. And look at the relative strength, not very good, but it is starting to turn up, good volume. And then CrowdStrike went off the back of my head and I'm like, yeah, let's just throw this one in there just in case. So software is starting to improve. So maybe I'll start including a little bit of some software companies that are beating, even if they're not showing a lot of relative strength just yet. I did that with semiconductors last quarter. So there were some semiconductors in here that I wouldn't have considered, but the group was so hot. It was like, well, I'm not getting great relative strength now, but maybe I will later. So there's some things like that that go into this. So this isn't, I get questions from members sometimes. They're like, why didn't you include this stock in? And I'll go in and I'll say, well, Zacks is showing that they didn't beat their bottom line, or, they didn't beat earnings, or they didn't beat revenues, or they may have beat on both. And I might look at the chart and I'm like, well, the chart just doesn't excite me. Yeah, they beat, but I just don't like the chart. So there's judgment involved, no doubt about it. But as you go back through here, all the more recent charts, like this one came down on Friday. This is a company just recently reported and lost what I thought was a short-term support level. Maybe we're going to go all the way down to that 865, 870 area. Applied Materials just came out with their earnings. Great earnings. Look at the AD line there. Relative strength's kind of gone back a little bit, but heading into earnings, I think, a lot of folks don't jump in right before earnings. So I give the company a little bit of a pass there. But this has been a really, really strong semiconductor company, and I love that AD line continuing to move up. So I could go through all of these. Here's Yeti, by the way. Yeti is one I added. I put in down here at the recent low. I could have probably put up maybe the close after earnings. But I felt like this was an area that had a little bit of resistance on the way back up. And then since breaking out above 38, we've gone down, tested that level 3 times. So that's a key support area as well. And then again, like I said, there's relative strength. Look at the volume coming in on this move to the upside. So there are a lot of good things I like about Yeti, but relative to the recreational products group, I think the stock looks really good. All right. I want to show you one more thing about these chart lists, because this is something, if you are a Stock Charts member, and I'm not trying to sell you on Stock Charts membership. I've used this platform for 22 years, 23 years now. So, I mean, it's, back of the hand, second nature for me. I love the platform, but I understand there's a lot of platforms out there and a lot of folks use other platforms. You don't have to be a Stock Charts member to get what you get out of earnings beats, but it does help, no doubt, because you can, like I said, download chart lists and so forth. But I want to show you what you can do. So I'm gonna pull up a new scan on Stock Charts, and here's the scan I'm going to do. I'm going to hit the new scan and get rid of that. In my account, I've got a lot of chart lists, so I can run scans against my chart lists. So I'm going to take this strong earnings chart list, add it with that plus sign. So now it's over in the scan criteria. And then I'm also going to take raised guidance. So this is a separate chart list that includes companies that have raised guidance over the last 3 months. And so if I run a scan and tell the scan engine to give me all the companies that are in these 2 chart lists, they have to be in both. And now I could do or, and that would give me a chart list of companies that are in either one. So it's going to be more than 573 companies. This one, because I'm saying and, has to be in both. It's going to be less than 573 companies. How many? I don't know. Let's run the scan and see. 179. So of the 573 companies in the strong earnings chart list, if we further refine and say, now give me all the companies that not only beat last quarter, but also raised guidance, then we're down to 179. And on Stock Charts, you can then click save on or save to chart list. You can put it in a new list. You can replace a list. You can merge with an existing list. You can do all kinds of things. But anyway, there's so many different things that you can do with our research that we do on the Stock Charts platform. Now, if you're wondering, if you are not a Stock Charts member, all of our chart lists you can still get in, I think it's maybe CSV. I don't know what form it takes, but we can give you the list, and then you can download the list into whatever platform you use. Or instead of being able to look at the whole chart list in the Stock Charts, you can actually look at one stock at a time in the chart list. You can view the chart list even if you're not a Stock Charts member, but you're going to have to view it one chart at a time. There's probably going to be ads at the bottom because you're not a subscriber. The subscription cost at Stock Charts isn't much. So if you're take advantage of our sale, you can literally take the savings from our sale and probably pay for an annual membership at Stock Charts and get us both for the same price. I mean, that's another way to look at it. And then the only other thing I had today, and I'm going to wrap up because I know it's gone an hour and 45 minutes. The only other thing I had was the strong AD list and the war room. So I want to show you the strong AD list first. And in this chart list, what I do is I start, every one of these, there's a process I go through to get these chart lists together. But I start with the strong AD chart list by looking for companies that have scooter scores, relative strength scores above, say, 80, 75, 80. If I get too many stocks, maybe 85, I'll refine it a little bit, but somewhere in there. So I'm looking at relative strength stocks, not only as of today, but part of the scan also will look back to more recent highs. So I could go back even as far as like the S&P 500 high, I don't know, from back in February, before the market tanked. And I could say, give me all the relative strength stocks back then and all the relative strength stocks now that are all over, that have scooter scores over, say, 80. And it'll look at both periods. And then what I do is I take all of those stocks. Usually it comes back. I try to get close to 1,000 stocks, and I will whittle it down to usually around 400, 401 on here right now. And I don't do that by design. I'm not like trying to get 400. It's just that what I do is once I bring them up, once I get this chart list of 1,000, I'll put them all in candle glance form. And what you're going to see for the most part are AD lines that are going up. Now I'm surprised that Uber's on here because that one's been going down for a while. But I think Uber might have been added by accident. Let me just look at this one real quick. I think, oh, there it is. That probably should be over in the raised guidance. I'm going to move it to raised guidance. Yeah, that wasn't supposed to be in this. I saved it to the wrong chart list. So raised guidance, May 15th. I'm going to add it in there now. And then I can delete it here. I should have just moved it instead of copying it. But anyway, all right, now let's try this again. I'm like, what the heck? Because that should not show up it shouldn't show up with a weak AD line. So at the top here, see all the AD lines moving pretty much up from left to right? That's just telling me that they all have strong AD lines. If you go through all of these, because what I do is when I start with 1,000, if one is going down, I hit this little trash can, boom, gone, gone, gone. I go through this whole list of 1,000 charts simply looking at AD lines, and the ones that I think are strong or relatively strong, I include in here. I don't look at anything else. I literally, now here's one that's starting to turn down since I added it. ALHC, now I don't go back in and adjust, but I do this once a month. So if it keeps going down next month, it won't be on the list. Some others are kind of choppy, and sometimes I include them, sometimes I don't. The ones I really like, let me see if I can find one that really, really looks great. Caterpillar. I mean, this one from start to finish just keeps going up. Price action. I mean, if I could give you a poster child of a chart that I really like, it would be Caterpillar. AD line going up left to right, price action up left to right, relative strength versus the group left to right going up, and the group relative to the S&P 500. You want a leading stock in a leading industry group? Look no further than Caterpillar. Caterpillar, there's a good chance Caterpillar could be in one of our portfolios again come Monday. But anyway, so this is the strong AD chart list. Last thing I want to do is I want to show you, and your screen's probably not going to show this just yet because I have to go back and find it. I'm going to bring up my war room and just give you a sense of what I'm going to show you on Monday. So just bear with me a second here. Let's see, last one would have been February. There it is. All right. This will give you a sense of what goes into this. So I am going to go back over. I'm going to unshare my screen for a minute so that I can share it again and see if I can pull up Excel. Now, I'm going to pull up my entire screen. That way, let me get rid of this. So that's going to confuse everybody. All right, let me now pull up my Excel spreadsheet. Okay, so in February, I'm showing you the War Room February. I haven't even done the War Room May. That's going to be this weekend and Monday. But just to give you a sense of what I do. remember I was showing you seasonality? So S&P 500, NASDAQ, Russell 2000, I go through and I get the monthly seasonality for the upcoming 3 months. And I put it right in here. And then I calculate the actual seasonality for the period by taking 1/3 of February, because we're starting on February 19th. So I just take 1/3 of February. I take all of March, all of April, and 2/3 of May, because the portfolio then goes all the way through May 19th, which is roughly 2/3 of the month. So, and then I add it together, and this gives me my seasonality for each of the indices and for each of the sectors right there. And then all of the industry groups. That's a lot of work, but I do that seasonality for all of them so that I can see quickly which ones really tend to like a certain period. Over in this column, I have the weekly PPO. PPO is a momentum indicator. So for each one of these, I like to see, okay, the S&P 500 has a weekly PPO of 1.989. So if I go in and I look at the sectors, you can see which sectors have stronger momentum right now, at least weekly momentum. And then I can also do that same weekly PPO for all of the individual industry groups and see what is showing strength. So this is just simply reinforcements in my head to think about what I want to do for the actual selection process. Now on my worksheet, I then have basically the same thing. Here's the weekly PPO carrying over from the other sheet. Here's my seasonality, 250, 388 coming over from here, 250, 388. So all I'm doing is just bringing that over so that on one spreadsheet, I have my industry groups, I have all the sectors, I have my seasonality, the weekly PPO, and then over here, I take the stocks. Let me go back over to let me show you, I'll give you a sense of what I do with this. Strong earnings, we go to summary, and I'm going to sort this by sector, industry group. Oh, and I also want score. And so now what I'm going to do is I'm going to put it in scooter order first and then industry group. And so now when I go to list aerospace, I know what are the best scooter scores in aerospace. So PL and Rocket Lab, RKLB, that's another chart I really like right now, Rocket Lab. This one could be a portfolio or portfolio stock come Monday night for next quarter. And we'll look at that chart in just a minute. But PL, RKLB, and I'll usually go down to through the 70s. So I'll probably list, like on the War Room sheet for Monday night, I will probably have these six, well, Atro's in here twice, probably because they reported like 2.5 months apart instead of 3 months apart. So they just reported, and their old report is still on the chart list, but that'll be coming off pretty soon. That's why sometimes you might see a company twice, not very often, but every once in a while. But anyway, we've got right here six companies, but one's a duplicate. So 5 companies on aerospace would show up. If I go down to aerospace, let's go to the XLI. So all the XLIs are here. Here's aerospace. So those companies, there's PL from last quarter. PL was there last quarter and still there. So PL would have been a nice selection last quarter. Let's just look at that chart first. So had we added PL back on February 19th, it was $24. It's $42. I mean, when I said stock selection falls into your lap, this is what I mean. Once I've done all my homework and I've got the themes done and I've outlined what I'm thinking about in the market and I've looked at different industry groups that I like, and I want to get certain amount of industrials and financials, all of the aggressive areas, technology for sure, discretionary, communication services. I'll give you another communication services company I like in just a minute, but this could have very easily been I wouldn't have put this in the model because the model tends to be bigger companies, tends to be a little bit, I don't want to say safer because they're all aggressive, but maybe safer, might be a little bit better, might be a word versus the aggressive. But I would have probably put PL into the aggressive if I was going to include it. That would have been a 75% gainer in a market where the S&P 500 has been up 9%. So do you see how this system works? That was one I didn't even pick. So part of it is going to come down to choice. You might be able to put together, I might put 30 stocks together, but you might have 70 in a watch list and just trade them because these are the best companies out there. I don't know how else to say it, but this is a perfect example. If I had picked Planet Labs, I'd probably be looking at more outperformance because look at the relative strength. What was it doing back in February? It had relative strength. And look what's happened. For the last 3 months, it still has relative strength. And it's done it with a group that has been horrible. This is why leading stocks are so important. Even in a bad group, this would have been a great gainer. Not easy to do that. So anyway, what I will do is I will go through every single industry group, over 100 of them, and I will literally manually put in here the stocks. Why did we pick Fastly last quarter? It was one of the highest scooter scores. Now, I knew Fastly didn't have a great long-term track record. It made me nervous. So I took two smaller software stocks and I combined them. So instead of having 10% in Fastly or 10% in MyTech, I had 5% in each. So I do occasionally stray from the 10 stocks in the portfolio. We actually had 12 in the aggressive portfolio because in the aggressive also I did small semiconductors because I love the semiconductors. And both of these did very well, ICHR and KLIC. But I was afraid to just put 10% into one small semiconductor. But here, this is how I went through and put the portfolio together last quarter. It's all of this work. This is my war room. This is getting ready for the draft. But again, the good news is we got the top 10 draft picks. So that's it. That's our system. This is what we've done now for 7.5 years. And this, by the way, is a fraction of what we do for our members. This is just a once a quarter thing. But there are some members who are members because of this. This is what they do. I know some members routinely get into this and follow this every quarter. I know some members write in and say, I've had one member write in and say that I go out 3 months and I do options on all of them and I go, a little outside the money. And he said, I've done very well doing that. Now I'm not recommending that. That's a very aggressive strategy where literally you could wind up with zero. I wouldn't do that. But certain members, if they're aggressive and that's what they want to do, that, we put the information out there. I will tell you right now, full disclosure, I do not buy the portfolios. I don't just jump in on May 19th and buy all these stocks in my own personal account and hold them for 90 days. It's not because I don't believe in them. I mean, we put our results out there for folks to see every single day. I don't trade that way. That's not my personal style of trading. I'm more of a short-term trader. If I get into a stock like NXT, for example, if I got into NXT and I bought it at 125 to 130 and it was 143 the next day, I'm telling you right now, that thing is in my account. It's gone. See ya. Thank you. And you know what? If it goes back to 130, I might buy you again. But I'm not looking at 15% gain in one day and saying, well, let me just keep holding. That's just not my style. Because if that stock broke down and I ended up getting out after 90 days and it was down 20%, that's not my style. And that would drive me crazy. I can't watch a stock do that. This was developed. Members asked us back in 2018. They said, listen, you've got hundreds of companies on your strong earnings chart list. I don't know where to turn. Do you have 10 or 20 that are your favorites? That's how the model portfolio was born. I was like, okay, well, let's take a look. Let's get some diversification. Let's stick mostly with growth. Let's do this. All the caveats. Here's the 10 stocks that we like for the next 90 days until next earnings season. That's how it started back in November of 2020 or 2018. And we've been doing it for 7.5 years. The model portfolio wasn't a great quarter this quarter. We don't always beat over the course of a calendar year, even. But since 2018, since November of 2018, the S&P or our model portfolio is almost twice what the S&P 500 has done. And I think that's significant. Our aggressive portfolio is about 50% above the S&P 500. Income, not going to outperform the S&P 500, I can almost promise you. Maybe in a down quarter, maybe if money rotates to value and more of the dividend payers are in favor, then yeah, occasionally you might see the income portfolio outperform, but usually it's going to trail. And as long as growth stocks are leading, the income portfolio normally is going to trail by a wide margin. So don't expect to outperform. That's not the purpose of that portfolio. It's more for folks that are interested in trying, they want to be part of the market, but they're focused a little bit more on income than they are growth. Most of the names in there are companies that have been around a long, long time, have decent long-term track records as far as dividends go, that sort of thing. But anyway, that's all I got, John. So I don't know if you got anything to add or if we want to take some questions.
I think we're going to have to wrap it up here, but a couple quick things. I do want to point out from feedback I get too on the portfolios, even though there are some people who, choose to go the full 90 days, a lot of people trade those stocks too. They're going to Fastly. I guarantee if there's somebody when it was up 50% or whatever was up, said, I'm gonna get out of this thing. So anyway, I just want to point that out. I think that people use the stocks for trading as well. A couple of people have asked about that flash sale. It goes till Sunday night. You'll save the $300. You get everything we do for a full year. It's I don't know. It's too cheap, but we want to build a community. We want everybody to get a chance to get access to what we offer. Tell your friends about it as well, and make sure you sign up for this thing. And Monday night, if you got to be a subscribing member to get access to the model portfolio and the aggressive and income Tom's picks. And one other thing I'll say, 6 weeks, we're like in the middle of May. 6 weeks from now, we're gonna have our quarterly update. Those are very popular because you saw Tom's historical data, seasonality, etc. We start getting to the second half of the year, things could change a lot. So I want to point out that Tom will also be having his quarterly updates along with Market Vision, which I think Market Vision itself is $700. So you get that as well. We're too cheap, Tom.
Actually, I think our Market Vision, when we sell it, is more than what we're offering this flash sale for, and that is available to all annual members. So you are getting in for a $700 value on first Saturday in January. As an annual member, you will get the Market Vision next year as part of this flash sale. So, that's, we try to price it as best we can. I mean, we can't give it away. We all work for a living, but we do try to price it that, most folks can afford it. This is really for those of you that are trying to, manage your own money. You're maybe kind of like me, you don't really trust Wall Street. I don't trust them. I certainly am not trusting them with my money. And so that's why we do what we do. And we do a lot of hand-holding coaching, I would say. And maybe even some of you that think, well, this sounds like too much short-term stuff for me. We have a weekly market report comes out that a lot of folks love because it takes a little bit more of a step back, longer-term perspective that comes out every Monday morning. So it's a once a week thing that provides you some, a little bit maybe coaching along the way from a longer term perspective. And in that report, there are some longer term trades that we've held, 2 or 3 years since we started that back in 2023, actually going on 3 years now. I'll show you a stock that we featured in there. This is unbelievable.
Hey, while you're pulling that up, somebody had a question I'm going to answer, asking how do we see when our current membership expires. If you go to the member page at Earnings Beats, your member page, and go down to the bottom where it says resources. You can click on a link where it says manage your account. And when you click on that, you'll be able to change your email address, your username, password, and look at your current subscription status. And the point being, I think if you want to take advantage of this sale, any unused time that you have on your membership will be added along with the 12 months you get at the reduced price. Okay.
All right. I did say I was going to pull up one other stock that I really liked for, this was Seagate, by the way. This is part of the computer hardware group that's really doing well. But this was a stock that we added, just to give you a sense of the long term. This was a stock we added in the long-term portfolio, I believe sometime during, I don't think it was 2025. I think it was maybe sometime in 2023 or 2024. Maybe it was during this drop. I don't remember. But anyway, look at the long-term. I mean, this was a stock that somewhere around $100 or less that we talked about within the last year or two, and now it's an $800 stock. JP Morgan is one that we gave away. That was the first one in September of 2023. It was $130 some a share. Now it's $300. So there's something for everyone in these portfolio or in all of the reports and everything that we issue. I think, taking a shot with us for a year. And again, I welcome any members' comments to post what you like, don't like about the service. I don't know if they've been posting or not because I haven't been following the chat, but I'm proud of the work that we do. Everybody at Earnings Beats and all the work that gets done and the commitment. We're a small team, but we work hard for our members. And we put a lot of work into reports and things that go out there. And I think we put out a lot of product and really good stuff. So anyway, take a shot. $6.99, save $300. Like John said, this or $6.97, whatever it is, save $300. This is the best price that we have offered since we put all this package, all these different reports, portfolios, everything together. $6.97 is the best deal that we have offered to the public. So
good.
Definitely check us out.
For golf.
Yep. All right, that's it. Now it's time for the PGA Championship. I had a draft with some friends, so I got Aubert and I got Gotterup. Those are my two big ones for the tournament. So I need one of those two to come through for me the next 2 days. But it's a tight field, so it's going to be a fun tournament to watch the next couple of days. Anyway, happy trading, everybody. Thank you all so much.
And guys, I just wanted to mention, if you guys have any trouble with the signups, you can reach out at support@earningsbeats.com.
Awesome. Yep. Thanks, Matt. Again, that is support@earningsbeats.com. If you have any problem signing up, we'll make sure we get you set up using the special flash sale price. Have a great day. Happy trading.